All right, I'm here with Peter Friedman with Agile Cap. We interviewed in the last part John Jameson. He works with sellers at Agile Cap. Peter, you're on the other side. You're working with the buyers. And, so today we want to dive into the world of buying an insurance agency. Specifically, I want to speak to someone who is maybe looking to buy their first book of business or their first book of business in this specific climate because it's really a tough one. That's where you come into play. But let's walk through. Let's say that I own an insurance agency and maybe I've got a few $1,000,000 in revenue and I'm like, I want to get on this, merger and acquisition run. And I want to start scooping up smaller insurance agencies and grow my book of business that way. Number one, thank you for joining us. I know you guys are busy, took time out of your day to do this, so we appreciate it. But I want to jump in. What's the very first step that I take as an agency owner looking to expand through M&A?
So step one, in many ways, it's very similar to the way to think about it, is that you were buying a home, is you got to look at yourself and what are your current financials, as you were buying a home, are your tax returns prepared and filed? What is the current status of, your bank accounts? If you filed your taxes, compiling all this information together so that it's readily available for you. And so step one is yourself. Hey, am I ready? Do I have all my paperwork ready? Have I thought through what I can and can't do? So then we think step two is a little bit more of a strategic. That first step is tactical, which is what can I acquire? Let's say I'm a couple $1,000,000 in revenue. You're not going to go acquire $10 million in revenue. That's just too big. It's the small fish acquiring the large fish. You're going to say, what's the size of agency? What can my people internally take in? And how do we do it? And how does that fit with our current book? Are we primarily commercial, or are we residential lines? Are we mostly home or non-standard auto? Kind of what is the matrix that we are? And then are we looking to add to that, or are we looking to fill in holes in the matrix? And so there's a tactical piece. Am I ready for this? And there's a strategic piece, which is what should I go acquire? Sure. Once you have those conversations, then you're kind of ready to say, start looking.
Yeah. So if an agency owner is in that phase, is that somebody that you guys go, yeah, come to us, talk to us, and we'll Absolutely. Help you figure all those questions out?
Yeah, so we are very, very comfortable sharing with you as to how a lender looks at you. And it's really a conversation around what we call the 3 C's. The first is cash, which is, and it boils down to something called a debt service coverage ratio. You'll hear DSCR as a common acronym. And that's really like, how much can you afford and to pay all your bills, all your expenses, our bill, the lender's bill, and then how much is left over or buffer. A good way to think about debt service coverage ratio is you can look at it from a business standpoint, or if you're a small business, you want to look at it potentially for what's called global, which is you personally, especially if you're a 100% owner, as well as the business, because small businesses blend with their owners naturally as it occurs. And you're looking for debt service coverage ratios, ideally that are what's called 1.25 or 1.25 times or greater. And that's a generalization. It very much depends. But when you start thinking about things, cash is the first, and we can help you work through that calculation, debt service coverage ratio. And that'll limit what size you can buy and how you can buy and so on and so forth.
Sure. Now, let's say that I'm a small agency owner and I'm looking to buy my first book of business. And, maybe like you said, maybe I'm in that $2 million revenue range, $2.5 million revenue range. What size of agency am I realistically looking at the potential of buying? And how much cash do I need to accomplish that? I guess, what's the maximum size of agency that I could potentially, and I know these are all hard questions, right? Because the short answer is it depends, but let's speak kind of to some general terms here, like just industry wide. What are you seeing agencies that are in that $2.5 million revenue range? Maybe they got a healthy, EBITDA, and how much cash do I need, and what type of agency size am I looking at buying?
So what our advice would be is not to bet the farm. So really, you don't want to go after too large of an agency, especially if your first acquisition. There is a learning curve here. If you've done 3 or 4 of these, you can do something larger. So if you're a 2.5 million revenue agency, you've got a solid operation, you got your manager who's running things, you got your producers and your CSRs, and you kind of got it, the operation down. You're looking for the next challenge. I sit there and say, you probably don't want to do anything that's larger than you are, and then ideally within 50% of you size wise. So let's 2.5 million agency revenue. You should be saying, hey, I want $1 million agency. Current market, that's probably a $2 million purchase price is what it's kind of out there. And then the numbers come in, which is, hey, how much cash can I put down? We really recommend in an ideal world, and this is ideal, is you're looking at 60% borrowed, 20% seller note, and 20% cash. That's a perfect world. We flex a lot. We flex to 95% borrowed, 5% cash, no seller note. It just kind of depends. So, but you like having those 3 components in the equation. So $2.5 million agency, you buy $1 million of revenue. That's a lot to digest. It depends on type of policies, carrier, overlap, big questions, agency management system. So these are the types of things we would advise you. But if you come to me, you got a $2.5 million agency, and you're like, I want to buy a 10, we would probably say that's a lot to chew. So we would say, if your first acquisition, go buy a $500,000 agency. How does that work? You spend $1 million, 2x times. It went really well. Great. 8 months later, everything's digested. Let's go look for $1 million. Let's start that train going. I think those are the guidelines you should kind of think about when the size of agency you're looking at.
Sure. And the nice thing about maybe scooping up some of those smaller agencies is there's not quite as much competition from your national buyers that are paying these huge multiples over EBITDA, right?
Yeah, so we're seeing national buyers scoop up anything that has $1 million of EBITDA or more. That's kind of, they're going to come in and they're going to pay you let's call it 8 to 12 times.
Right.
And you're probably getting 6 to 8 times in cash up front, and a bunch in earn out afterwards or equity or something like that. Sub $1 million EBITDA, there's competition out there, but it's not from the national brokers. It's from people like yourselves who are trying to gain scale. And the beauty of this industry is, if you have a $2.5 million agency, you probably could take in another $500,000 of revenue with virtually zero costs. And so you could take, let's call it 20% cost. That's 100,000 costs. You're dropping 400,000 in cash to your bottom line. You spend $1 million. It's not going to cost you that much to do that. So that's the beauty of the model. You go, and it depends. You go buy a $2 million agency, your costs are probably 60%. And it's still great math, but it's a different sort of acquisition. So there's things you got to think about. So cash is one.
For sure.
Another one is collateral, which is essentially how much is my agency worth relative to how much I'm borrowing, right? It's the same as a house. If the house is worth $1 million, you can't borrow $1.2 million. Banks are not going to let you. For the most part, they lend between 60 and 80%. That's kind of normal. A loan to value is another way to think about collateral. Same thing with an agency. How much debt do you have? How much can you borrow? Things of that nature. And the third one is what is the last bucket, called character. So we're on the 3 C's here. Character is everything from credit score, prior credit history, bankruptcies, how much personal credit you have extended, things of that nature. And it is, are you an efficient operator? Do you know what you're doing? To be honest, when we go visit you in your office, is your desk a mess? And is there paper everywhere? In today's world, we don't like to see paper. You don't like to see paper. We love to see a dialed in AMS system where we say, hey, tell us about your book. And you're like, oh, here's the report. We love that. And so that falls into that character. Are they a smooth operator? Are they capable of doing these things? So those are the 3 C's we as a lender look to. We can start with you before you have a target in mind. We can kind of say, hey, this is how you should think about these things. Or if you have a target and I need to close in 2 weeks. And it kind of depends on the situation.
Sure. So tell me about, let's go back to that $500,000 agency that we keep talking about, because I think ultimately that's probably, for most people, that's going to be about the smartest move they could make.
Absolutely.
Because you could absorb that in. Probably your current staff could service the book.
Yep.
You don't have a lot of overhead. Maybe you don't even have to take the staff of the agency that you're acquiring in the acquisition, probably. So let's go there. I'm borrowing $400,000 on this $500,000 book of business. I'm putting down a little bit of cash. Maybe there's some, payouts or stock options or something like that for the current owner. What does my payment on that look like? What's the term? I mean, I know payment's going to be obviously dependent upon interest, but like what kind of terms are available to me? What are industry standard, interest rates, things like that?
So there's something we call the lending landscape, and we have an actual document. You can download it from agilecap.com, and it kind of lays out what the world looks like. Mm-hmm. And it's essentially, we'll go from the lowest cost kind of money right now. The benchmark right now is an SBA loan. SBA loan has lots of pluses, lots of minuses. The rate is between 5% and 6%. It kind of depends what you're borrowing, size, bank you're getting it from, but count on it being. And we're about to enter a rising interest rate market, so that's just going to naturally go higher. But you're looking at 5 to 6% in the SBA market right now, with its pluses and minuses. If you're a much larger agency, very high quality credit, you might be able to get close to that 5%. But I think that world is changing right now, as we all know about interest rates. And term-wise, it's funny. If you too small of a loan to an agency, most lenders are going to want to be like, hey, just pay it off quickly. Do it in 5 years. But on average, terms out there are a maximum of 10-year amortization is how you want to think about it. That's kind of the max you should expect. But a very small loan relative to a larger agency, most lenders are going to push you and say, hey, just pay it off. Why? You have a lot of cash. Why borrow it? But think about between 5 and 10-year terms, interest rates 5 plus. 5 is your top credit. You're borrowing a small amount. You have your personal financial statement of PFS is very strong, like you have a ton of retirement money, good life insurance, things of that nature. Above 6%, you go to a specialty lender like ourselves. A lot less constraints associated with the loan than an SBA, which is a government guaranteed loan, but you're going to pay between, let's call it 6 and as high as 12%. And that 12% borrower is someone who has very poor credit history. Maybe he's borrowing too much relative to the size of their agency, things of that nature. So let's do quick math, $400,000. Let's say you're straight down the middle, you're a 6% borrower. So your interest cost year one is about $24,000, 400,000 times 6%. And I'm doing this off the top of my head. It's not unusual in year one, your payment is essentially going to put a half that amount or twice that amount in premiums. So your payments are about $5,000 a month. Is the way to think about it. And it depends on amortization, term, all sorts of things, but that's a good way as a placeholder. So $5,000, let's call it $60,000 a year. Your lenders want to see, after you've paid all your expenses, paid yourself a living wage that you're accustomed to, and that you've been living on. If you've been living on $500,000 a year, your lender is not going to say, well, next year you're going to live on $100,000 or $50,000. If you've been living off $50,000, that's great. It depends where you live in the country and so on and so forth, on costs. And they'll say, okay, pay yourself, pay all your expenses, pay everything, pay the borrower, and we want to see you have a little bit extra left over. And that's that debt service coverage ratio 1.25. So those are roughly how the numbers work.
But on a $500,000 agency, I mean, you're bringing in, a little under $42,000 a month. So, at $5,000 a month, I mean, you've got a lot of room to.
Exactly. And that's why there's massive kind of economies of scale in the insurance agency world, is that $2.5 million agency can buy a $500,000 agency. You could keep one CSR, you could keep the office space and the paper and all the other costs, and it still costs you only $100,000 a year. You have $400,000 a year. You drop to your bottom line, and you're paying $60,000 in interest costs associated with it and payments and stuff. So You're exactly right. That's why it's awesome.
Yeah. Well, and then so let's say that I do this. So I go through, I finance about 400,000 of it. My payment's about $5,000 a month. I've got all this cash room now, and maybe I'm smart and I pay down a bunch of or should I pay down a bunch of the principal on that existing loan to, like, this acquisition went well and I'm going to head out and start looking for my next deal. or am I better off having that extra cash on the books for the next purchase and maintaining the debt that I've acquired through Agile Cap or the SBA or whoever it is?
Yeah. So um, in this example, you're better off maintaining the debt.
Okay.
Lenders like to see you borrow an appropriate amount of money, consistently pay it off, have no problems. You know, when the annual review comes around and they ask for your updated tax returns and everything's gone well, they love to see that. Paying money off early isn't always a benefit unless you're over levered, right?
Okay.
So there is credit card companies like to see you use the credit card. Banks like to see you use the money. It's the same idea. Credit card companies don't want you to max out your balance in any sense, but they want you to maintain maybe a little balance, or just they make money off you using money. Same with banks and lenders.
Sure. So then, how long until, and we'll dive into agency specifics and what banks are comfortable with and what they're not. But how long until you could potentially acquire your second agency after you acquire your first, or should you?
I'll tell you what we've done. We've done up to 3 transactions at once, day one. So that works out. Now it's always hard to do the timing. We have done multiple transactions in a 6-month period. We've done one a year. But we're a very flexible lender. A SBA loan is not going to like to see more than one a year at maximum. They want to see you integrate it. They want to see you get through renewals on all the policies. They want to see you if you hit bonuses, if there's any new carriers. They want to see new tax returns with the integrated opportunity that you just acquired, all those types of things. Generally, with your lender, you want to be upfront as possible. Also, you want to sit there and say, hey, I want to acquire this business, but I got 3 others in sight and I want to get them done in the next X number of months. So it depends on the operator. The operator who is disorganized, has never done an acquisition, maybe is slightly understaffed, you're going to sit there and say, hey, you're probably not ready. Let's do one. And the flip side is highly organized, staffed up correctly, efficient. We say, great, let's do one every 6 months if that's what you want to do. We have done the full spectrum from 3 on day one to 1 a year over 3 or 4 years, and building an agency from 5 to 600,000 to over 3 million in revenue in really about a 5-year period. And that's what ultimately I would imagine your listeners are trying to do.
I would imagine too. So let's go into look at like the characteristics, right? There's mainly auto insurance agency down the road from my agency, let's say, and they don't have a lot of home on the book. Maybe I'm a home and auto guy. But this agency down the road is mainly auto, maybe even like, SR22 high risk type auto insurance.
Yeah.
Are what lenders willing to lend on the agencies highly dependent upon what's in that book of business?
I wouldn't say highly, but that is a material factor.
It's a component.
It definitely is. And it's, hey, I'm a straight home guy. Home turns over once in 20 years. I've been a residential guy for a long time. I've never had any issues. My loss rates are low. And then I want to go buy an SR22 book. You're like, well, okay, these are totally different animals. This is auto, non-standard. Are you sure you want to do this? And we're going to raise some flags and be like, okay, you have to start small. You have to figure out how this works. It may be in a totally different community. It may be crossing language barriers in that situation. That's pretty normal to have. So we do look at it. But hey, same carriers, both. One does home and auto, and the other one does home and auto, and there's great carrier overlap. We love that because there's, the field service reps are usually the same. Everyone gets to know each other. It's no problems. So we look at it. It's a component. It's not the biggest component, but it's one we definitely talk about internally.
Sure. And I mean, and that obviously makes sense. And lenders specializing in this industry, I'd expect nothing less, because that's your business is highly dependent upon the customers that you get and what your book is composed of. So it makes sense that lending would be that same way. So tell me, when the agency owner, that they get everything plugged in, they get their financials over to you guys, and they say, I want to find a home and auto book, or I want to find, auto book, or whatever the class is. You guys have buyers that are coming to you also that make it to where you have available inventory or not? I would say, how does this work? But your answer 5 years ago would have been totally different than the answer you're about to give me right now.
That's exactly right.
What do you do now? Because that's the biggest thing, right? Is like, I mean, okay, you got your financing lined up, you can do all this stuff, you got cash. Now, where do you find the agency to buy?
Yeah, it's tough. It's the toughest it's ever been by far. And so there are some listing agencies out there who list agencies for sale. They're good resources. The problem is that they're public in nature. If we know someone who's a seller, we will try to match make to a very specific buyer that we know is a great fit, and we're looking for solutions. We're not going to publish a list that exists out there. It's a good place to start to look. The problem is everyone sees it. If we have a great match, we'll make it. But right now it's rare to have a great match. And so what we are advising people to do is do a very active search. Essentially, take the time in your neighborhood, loosely your state, things of that nature, and start almost cold calling and going out and looking for someone who's willing to sell. It's to find someone who's selling is hard right now. Buyers, and this was the reverse of 5 years ago, plus, where it was very much, 2012, 13, 14, no one was really buying. It was just, the trend was just starting out, and it's hard. If you came to me and said, hey, I want to spend $1 million and I want to buy $500,000 revenue in the state of Oklahoma, I'd be like, I don't know. Now, there's some more active markets where there's a lot going on, Texas, Florida, California, just by the nature of their size. I'd say, okay, let's expand it geography wise. Can you drive 2.5 hours between offices? Those types of things. Yeah. So it's hard is really the answer right now.
Absolutely. But that's something you guys can help facilitate the search.
We can facilitate it. But we're not always going to be able to facilitate it.
Yeah. Well, and I think that's just anybody in the market right now, right? Because, I've looked on some of those agency for sale by owner type sites, I guess is what you call them. And it seems like, probably the ones that are anywhere in the realm of normal go on and off of the listing in a period of probably a few hours. And then
don't even make it to the listing, to be honest.
Yeah, they don't even. When we sold our agency, it was 2020, so same climate. A couple of years ago, we never listed. Nobody even knew it was for sale, except the people that our advisors approached to tell it was for sale.
Yeah,
and then we sold before I think it was 4 people that they approached, and we got like 2 or 3 offers, and then we closed, but. That's the hard thing, right? Is like anybody that's listing on those sites, I don't want to say it's a waste of time, because I'm sure that there's like diamond in the rough type stuff going on out there where you could luck out and find something if you're really, really diligent. But like a lot of the stuff that sits on there, if their agency is, if the listing is a month old,
I think that's a good way to think about it. Generally, it could be it's a quirky book. It could be
they're asking way too much.
It is possible things that end up there, or they acquired it 6 months ago and they're just flipping it. That makes people wary of acquiring it because the seller doesn't know what's in the book. You have those dynamics, but you're right. If someone is looking to buy, it is a much more, hey, you got to reach out to individual agencies that you think may be good targets for you and have personal conversations. And it works, right? If you're of a certain size, to be honest, go to the national brokers. They're going to buy it for the best price, and that's it. But if you're below that size, or what you're looking to buy is below, then it's a very one-on-one marketing sort of approach to buying an agency right now.
Yeah. What is if you had to sum up the sum of your advice for buyers? I know that's hard too. Yeah. What would be the line that you'd leave them with?
I think the summary is make sure your own house is as clean as possible, number one. And 2, the second point is the diligence, time, and dollars you put into your target will be worth it 10, 100-fold down the line. Don't just buy anything. at the end of the day.
Yeah. Don't buy something for the sake of buying something.
Exactly.
I try and tell my kids that all the time. It does not work, but
that's a good way to think about it. So I'd say make sure your house is in order and don't buy something just for the sake of buying. Look, the industry will be around in 5, 10, 15 years. We're in a hot cycle. Maybe keep your powder dry. That's it.
Sure. Do you see it cooling off?
Look, I think the big players, inflation and rising interest rates will start to mitigate things a little bit. You see some noise in specific markets, the Florida home market. You see some carriers pulling out of things of that nature that all point to, we probably hit the apex about in the last trailing 12 to 24 months of things. I don't see a cliff. I don't see the world radically changing, but I do see we're probably not going much higher than we kind of are now. I think it's trending towards cooling off by its very nature of, cost of money, things of that nature.
Sure. Well, and then too, I think that, you can only pay so much before, like, where they're converting these agencies cash flow into, like, can't really get much higher either. And then the inventory that they're running out of in those, $1 million to $3 million EBITDA range that they're looking to scoop so quick, that's starting to run low too, right?
That starts to run low. You'll probably see, and this is like a 5 to 10 year horizon time, that some of those kind of roll ups start to fall apart and things of that nature occur. There's still a dominant role for an independent agent out there to produce a great business, and for themselves and for their clients. I don't think the industry as a whole going away, but I think there are definitely some changes going on, and we just need to work with changes.
Sure, absolutely. Well, now it's time for that next generation of $500,000 to $1 million revenue agency owners to grow those books up and get them.
Those are the really those are the fun ones to work with, because they're young and hungry and hardworking, and they're the ones who didn't grow up in a period where in reality there was a lot gifted in economic value over the last 30 or 40 years, and now they got to work hard for it. And I think that's really interesting to see how they're hustling and how they're thinking about technology and how to be the best solution for their customers. So look, we love it when pick a 35-year-old woman who's been around the industry for 10 or 15 years and is really hardworking, and it's like, okay, this is what I want to do, and here's my plan. And we're like, okay, let's go run together. And we're very supportive of that.
Sure, absolutely. What does it take to get the 95% financing level?
So
somebody's thinking that, right? You said it earlier, and I popped into my head a couple of times, and I'm like, what does that deal look like?
So the deal looks like, a larger agency buying a smaller, very digestible piece, a common system. So if they're on the same AMS platform, that's key. If they're both home and auto with similar carriers, things of that nature that essentially de-risk the solution. So we sit there and say, okay, got it. There are times we've done 100% financing, so it's even higher than that, but it's got to be $1 million agency buying a $200,000 book, 2 towns over. We're going to keep the office open, but we could close it to save costs if things go bad. But it's the same carrier, same reps. Everyone knows everyone. That's great. So that's the type of solution that gets 100% financing and gets closed in. Our record really is $3 million in 3 weeks is what we've done. That's kind of the record. We do, so that's fast.
Yeah.
You should expect something between 2 and 4 weeks to take. Most of that time is waiting for the seller to get you documents.
Yes.
We're waiting and you're waiting.
Sure. Well, perfect. Anything that you feel is pertinent to add? I know we've covered a lot.
No, I appreciate the time. Feel free to reach out to us anytime, agilecap.com. You can do Peter at agilecap.com, and I'm respond to emails all the time. Get on a call with you, anyone on my team. Happy to, whether you're trying to close something in a handful of weeks or you're thinking about it and how to think about it, any one of us will be happy to chat with you.
Yeah, absolutely. Give them a call. Go to agilecap.com. That's how I got in touch with you folks. We totally appreciate it. And hopefully at some point we'll have you back. I'd love to.
Thanks, Abe. I appreciate it. Have a great day.
You too. Thank you.